Welcome to the Planet MicroCap Showcase Vancouver 2024 in association with Small Cap Discoveries. I'm your host, Robert Kraft. And joining me for today's keynote Q&A is Richard Carleton. He is the CEO of the Canadian Securities Exchange. Richard, thank you for joining me today. How are you doing?
My pleasure. Yeah, we're doing well. The markets, obviously, we're going to chat about that, have been a little challenging, especially for the small and micro cap companies over the last little while. But I think it's fair to say that there's some optimism on the horizon, and we can talk a little bit about how and why we see things playing out over the next little while.
Absolutely. Well, look, it's been a minute, actually, I think, since the last time we, either just had a casual conversation, let alone doing something on here or doing an interview and whatnot. So, to kind of start us off, you alluded to my first question, but wanted to get your perspective on just the general state of the markets, and let's try and keep it specific to, Canadian markets, Canadian microcaps. What are you seeing? What's your take?
Yeah, I mean, obviously, the attention from a lot of the investment community, and that, of course, includes the retail folks in particular, has been driven by the performance of the Magnificent Seven, right? And so that the stock market performance, certainly in the United States and similarly in Canada, has been driven by the large cap space. And in fact, the performance is in fact concentrated in a relatively small handful of stocks. And again, I think it's fair to say that we obviously had a very robust marketplace in the microcap space during the pandemic, really up until about early 2023, late 2022. And I think in conjunction with the rising interest rate environment, concerns over the impact of rising inflation on disposable household income, and of course, the opportunity to earn pretty nice rates of return with bonds and with guaranteed investment certificate type investments. We saw a retreat, I think, of investors from the microcap space in Canada specifically. Now, somewhat ironically, of course, is that against that, we saw a tremendous number of companies which were financed really beginning in 2021, 2022 in the so-called battery metals space. Or in other words, people investing in the energy transition trade. And so a lot of those companies came out, were supported initially, right? They raised the capital required to execute the first phase of the drill program or the exploration activities. And then we saw those companies back in the market late last year and through this year, having a pretty challenging time attempting to raise capital. And again, talking to the CEOs of many of these companies, again, the investors were in an environment where you could get a 10-year Canada government bond or a T-bill for north of 5%, effectively risk-free. Canadian banks were yielding in the 6 to 7% range. So it was, I think, extremely difficult for companies with those investment alternatives available in the more senior sections of the market and then the debt side to persuade institutions and retail investors in particular to provide the second and third tranches of funding for these particular companies. And we saw similar challenges in the other business sectors represented in the small microcap space, life sciences, technology. And of course, this was at a time when we had a number of companies that were looking to invest in artificial intelligence and large language models and so on to provide various different business solutions. And again, having a very difficult time trying to raise the capital that they needed to get listed in the first place, and then to basically grow their companies. So again, it was a real challenging environment really for all of these companies, both the existing issuers as well as the companies hoping to go public in Canada, really up until June or July of this year.
Very good. And thank you for that full overview. I mean, there's a lot of different places that we can go there. But I wanted to start off with this because this has been probably been one of the number, if not the number one theme, I think, in just the general microcap space. And this specifically, it pertains to Canadian listed market, is that takeouts, acquisitions, PE coming in and scooping up some of these names. Seemingly one a week. I feel like a broken record at this point because I feel like I've just been talking about it with everybody, but that's been very much on everyone's mind. Is you just see another. We're recording this on September 12th, 2024. Our one of our hosts of the show, Paul Andreola, he put out a tweet saying, I think it was Altius just got taken out. So was not a shareholder, but so I mean, from disclosures. So I mean, from your perspective, why do you think this is happening? Are you seeing this happen also in frequency or any sort of frequency from companies listed on the CSC? And do you expect that to continue?
So I think the trend is driven by a few fundamentals. The first one is private equity is sitting on a lot of dry powder. They have a lot of cash. And that's been the case really for the last 2 or 3 years. The second thing is that from their perspective, when they look at the valuations for many of these companies, particularly in the tech space, and again, it's fair to say that a lot of these companies are trading at considerably lower than their IPO or their initial listing price on the various exchanges. So that when the private equity guys look at both private companies and public companies, they're I think in many cases determining that the market price, as determined by the activity on the exchange, does not in fact reflect the intrinsic value of the company. And so company founders, of course, especially the ones that the newer management teams who may not have much experience in the public markets, of course, they see all of the additional challenges, I guess, of managing a public company, right? The continuous disclosure requirements, the financial reporting, the governance requirements that you have to meet in order to, of course, satisfy the exchange and the particular securities regulator in the jurisdiction that you're operating in. And so, if the PE folks show up with something that represents a premium, a decent premium over the recently traded price of the stock, and freedom from the expense and time involved in managing the company as a public concern, I can see why a lot of the management teams, in fact, have jumped at that opportunity. Again, the money is there, the checks are being cut, and again, I understand completely why the management teams would do those deals. And I think the other thing that it does remind all of us who are operating in the public equity markets is, this is real competition. And we've got to sharpen our game. We've got to look at the regulatory infrastructure. Are the burdens too high, particularly on the small companies? Is the cost of capital from the public too expensive for these companies relative to private equity investment? So again, those are things that will make us better, and the competition is healthy. But yeah, I think an impassionate observer would say that private equity may have the upper hand at the moment.
Absolutely. I mean, I think it's my own personal opinion, and this is after talking with a number of investors that, because some concern would be out there is like, well, is there, what's going to happen? Or they're going to be, new public companies to replace some of these old. It's like, it's simple supply demand. Like,
yeah,
they're going to come. It's just a matter of at what stage of their life cycle they're going to be going public at, right?
Yeah.
And I think that I think it's going to continue to happen where they're going to be going public a little bit earlier in their life, especially in Canadian markets. The ecosystem up there is just so much more robust in many ways, which is kind of crazy to hear from an American.
Yeah, I think that's right, Robert. Now, some of the issues, though, that will help get us there in some measure is that, private equity, by and large, steers clear of the early stage mining business altogether, right? It's too risky, or beyond their risk appetite, I think, to invest in those companies. And as long as that's the case, then we'll continue to see a healthy supply of those companies coming into public markets in Canada. And where you do see private equity, though, coming in is at the later stages when the project has been advanced to the way beyond the feasibility study, and in fact the company is looking to raise capital to build infrastructure, a mill, some kind of processing facility, to dig the shaft or to open up the hole. And at that point, I think there is an important role for private equity investors to, in fact, work with the public markets to get these companies to a producing level in the mining industry specifically. But again, many of the companies that we've talked about who have gone public over the last few years and then been taken private by private equity investors over the last year and a half or so, generally speaking, in the tech and the life sciences space. So as I say, mining is sort of our last bastion. But again, I think you're right. We will continue to see these companies come into the markets, and in large measure because, in fact, many cases the market capitalizations are quite small, and they just aren't even going to move the needle for any decent sized private equity investor.
You think mining's the last bastion for
Might be.
I don't know if I agree with that so much. I mean, I only push back because I mean, look, the audience you're speaking to right now, the companies that are presenting at this event, there's no mining companies here, not one.
All fair. And as I say, the question here is again, how big are they at this point? Mm-hmm. And again, as they mature and do obtain, say, growth capital from the public markets, there is an opportunity down the road potentially for them to see, private equity exits from the company down the line. So, yeah, that's absolutely fair. But I will say, for example, if you look back on the history of the oil and gas exploration, at one point that was very risky, and it was capital was raised in the public markets for those particular companies. Then the seismology got so good for the oil and gas exploration. In fact, the companies knew before they drilled the hole what the flow rate was likely to be, what the distillate mix was going to be, and what the likely lifespan of the well was. And so very quickly, it morphed from a public markets investment to one in the private equity sphere, where, again, the company would need to drill 4 to 6 horizontal wells at $40 to $50 million a piece to exploit a particular basin. And that would be 6 or 7 calls to pension funds and other sophisticated investors in the oil and gas space, and they would have their money, and away they go. So, as I say, the mysteries of hard rock geology are continuing to work in our favor at this point. And as I say, as far as early stage goes, the public markets will continue to be the source of capital for those companies.
Oh, for sure. I mean, from your perspective, you're running an exchange here in Canada here with the CSE. I mean, what are some of your concerns with the exchange in running the business and listing? What keeps you up at night right now as we sit here recording this today?
Well, I've really touched on it already in some respects, because we have to, as I say, tighten our game as the operators of the public market system. And we believe passionately in the power of these public markets. It's democratizing, right? The fact that anybody with a few bucks can buy into these companies during their fast growing phase, when the wealth that generally speaking is generated, and participate alongside, some of the biggest, most famous investment names in Canada, the United States. I mean, that's an amazingly powerful vehicle. Whereas, of course, from the private equity perspective, that's the 1% of the 1% that are essentially supplying the capital into that space. And if you want to talk about, really deep thoughts on this space, it promotes income inequality if the wealth being generated by these fast-growing companies goes into the pockets of the 1% of the 1%. That's not a long-term. That's not a long-term plan for economic stability in our developed economies.
So another question I have for you, when you look at the pipe of, companies that are looking to list on the CSE right now, what have been some of the more active sectors that have been looking to come on the exchange? Love to hear more there.
Yeah, so we've got from a mining perspective, there's been a tilt towards the gold and precious metals exploration space, and for obvious reasons. With gold over $2,500 an ounce, that's a very attractive price point for the industry. And so we are seeing companies with interesting projects get funded and get onto the markets. I also touched a little bit on the AI, and of course, AI in and of itself it's a tool, right? So it's a case where somebody has to come to market with an AI application that solves a business problem in a particular industry or a particular consumer segment, for example, right? And so we have a number of companies which, would think of them as fairly typical tech companies, which have got a component of AI or machine learning in their tech stack, also getting sufficient interest from the community to get into the public markets. We've also seen a little bit more interest in the psychedelic space again. Of course, the cannabis space we haven't seen anybody new in the space, but of course, there's been a lot of trading activity as we've seen proposals to potentially reschedule cannabis in the United States. Of course, as you know, we have many of the US companies are listed on the Canadian Securities Exchange. So investors are obviously watching the progress of rescheduling and the potential impact on the tax position of the US operators, which would be very, very favorable for that industry segment. So again, that's driven a lot of secondary market trading, as we've seen good news, disappointing news, more good news. Like it's been relatively volatile. And so again, a lot of trading activity has been generated from the news there. We've also seen, again, a lot of companies in the life sciences space over the last year or so in a variety of ways. I mean, fairly typical research organizations that are looking at the potential therapeutic benefits of a particular compound. They will do early, preclinical work, and then presumably if there's substantial merit in the approaches that they're taking, then you begin to see partnerships with major companies to help fund the progress through the FDA regulation of the potential pharmaceutical.
Oh, psychedelics is making a comeback, huh? All right. Okay. Let's
Well, I will say, Robert, this is not, and I always caution people, this is not sort of cannabis 2.0 in the sense that I don't believe you're going to see a significant move towards legalization of psilocybin, ketamine, LSD, and some of these other compounds for recreational use. What we are seeing is companies that are looking to research the therapeutic benefits of these compounds and very much looking at these compounds as pharmaceuticals potentially. And so again, you don't think of them as a consumer packaged good company like you might a cannabis company. These are more akin to the traditional life sciences companies that, as I say, are looking to advance a compound through a very strict, lengthy, and expensive regulatory procedure.
Okay. We all remember what happened during the psychedelics boom, and now it's kind of in the doldrums, and now it's kind of making a little bit of a comeback. So, okay.
Well, I think the underlying fact here, which people should never actually lose sight of, is that there is a substantial body of anecdotal and old clinical data that suggests that whether it's for addressing depressive illness, addiction, anxiety, PTSD in particular, there's a lot of knowledge existing which indicates that these compounds, when used properly in an appropriate therapeutic setting, work essentially better than anything that's on the market today, and potentially by a wide margin. And so, that's why the advocates are continuing to work through all of this, because there really is potential here for some, life-changing therapies for a wide section of society. So,
Absolutely. All right. Well, we're coming up on our time here, but I wanted to close this out with a question about, one of our topics was the idea of utilizing Canada and Canadian markets to access North American and global pools of capital. How one, for those that don't know the CSC, how is the CSC uniquely positioned in order to help companies do this? And what
yeah.
makes you guys unique and different? And has anything changed now over the years? Richard, we've known each other for a while now, right? Has anything changed, over the years
Well,
in terms of
we're a lot
access?
bigger. We're a lot bigger than we used to be.
Yeah,
We have
yes.
a lot more issuer companies than we did, and of course, to accommodate the needs of the companies which have succeeded, we have a so-called senior tier of companies, which would be in a position to list on other senior markets in Canada and the United States. So that was a big achievement, basically over the course of the pandemic that we were working on that. But basically, the underlying theme here, Robert, is that Canadian public companies travel really well globally. Okay? Not just companies on the CSE, but Canadian reporting issuers generally. So regulators in the UK, in the EU, in the United States, in Australia, and South Asia have tremendous regard for the regulatory framework that we have in place, the market regulation, the oversight, the financial reporting. And as a result, we have a lot of opportunities for issuers that are Canadian reporting issuers and listed on the CSE to raise capital in the United States and access the exempt markets in the US. We have fast track access to exchanges in the UK. We have companies that are accessing the European markets, via either a Frankfurt quotation or Frankfurt listing. We've been working with a number of partners on the trading side to open up the links so that customers, particularly in, say, Germany, Austria, Switzerland, who've always had a really strong affinity for the Canadian precious metals market, can trade directly onto the CSE. Similarly, of course, as you know, our issuers are able to trade over the counter in the United States. They don't have to become U.S. reporting issuers, so they don't have to absorb the expenses of being a U.S. reporting issuer and providing the audits and Sarbanes-Oxley compliance and the expensive directors and officers insurance that you endure in the United States as a public company. So you get, in effect, all of the benefit with very little of the cost, yet the opportunity to access secondary market liquidity in the US via the over-the-counter markets. And there's a lot of arbitrage cross-border, so that it means that the US dollar price is always in tight sync with the Canadian dollar price. And those two pools of liquidity that kind of feed off of each other, in fact, provide a multiplier. So issuers have a tremendous benefit by not being limited really to the home market, but again, having a robust secondary market available to them in the United States at extremely modest cost. So, you asked earlier, and I don't think I answered you, but what keeps me up at night, and it really is these issues, anticipating what are the roadblocks that our issuers are going to face in accessing different pools of capital in different parts of the world. And I mentioned, again, things may have been a little tough or are a little tough in Canada at the moment. Our issuers are going all over the world for money. And that means that we have to go along with them to basically help plow the road, to use a Canadian example.
Winter is coming.
Yeah, winter is coming. And so to anticipate the challenges that they will have and to do education with the local finance community and so on, as to the strengths of the CSE. And ultimately, the secret sauce, of course, is that we do represent the lowest cost of public capital for a Canadian reporting issuer by virtue of the approach that we take to regulating the companies and the expertise that we bring to the table, which means that for most companies, the path to the public markets is the quickest, the least amount of risk, and the most cost effective when you're on the Canadian Securities Exchange.
And that's a great place to end it. Richard, where can our audience go and find more information on the CSE?
Well, we have a new website reflecting our corporate rebranding, which is about a year old now, at www.thecse.com. That's THECSE.com. We are also all over social media, YouTube channel that we create content. We help our issuers engage with the investment community via that channel. A lot of subscribers, and we've been very active in assisting our issuers basically reach a global audience through social media and YouTube. It's been a really exciting and fun ride on these new channels.
Awesome. Well, Richard, thank you so much for joining us here today to share some thoughts and highlights and updates, what's going on in the Canadian markets. We really appreciate you. Take care, be safe, and I look forward to our next update.
Absolutely. My pleasure, Robert.
Thank you.